Ladies and gentlemen, good morning. It's indeed a great honor to have been invited to give this annual lecture in the year of the 50th anniversary of Suerf and here at the Duisenberg School of Finance in Amsterdam. Today, as we all know, we still live in the aftermath of the greatest financial crisis since the Second World War. It has shaken confidence in the bankers, and the financial sector at large. Many people argue that banks have been value deductors rather than value creators. They have become too big to fail, too big to save, or too complex to manage. Much new regulation has been enacted in the meantime, but there's still a lot of anger towards banks and bankers. And there's a moral dimension to much of the criticisms. Banks and bankers have taken irresponsible risks. They have strongly benefited in the upswing and left the taxpayers with the bill after the crisis. That's the view. This has triggered calls for further, more fundamental change in the financial sector. Bankers have lost sight of their clients, focused too much on the short term, and too little on what is in the longer term interest of society. Changing this should require a change in culture inside the banking sector and also a change in many banks' business models. Clients should take central stage far more than was the case the past decades. Today's conference, as already explained, focuses on the issue of the value of the banking sector to society and on business models in the banking sector. I will also focus this annual lecture on those issues. And I will prepare the ground by briefly discussing economics as a moral science, the root cause of financial crisis, the role of banks in society, and the decades-long process in the run-up to the financial crisis of 2007, which I call the period, and Ernest already said it, of the great financial expansion. And this is then the context in which I will discuss the value of banks to society and also will say something about their business models. I am an economist, and perhaps it requires some explanation for an audience like today why an economist should speak about an issue also taking a moral perspective. For indeed, it's largely forgotten that economics used to be a moral science. And in my view, it still is and ought to be the case to make sense. When I speak about the value of banks, I have indeed in mind more than just value in terms of monetary added value. As already said, I believe that the debate about banks is not just about added value expressed in money. In modern mainstream economics, the decision maker is modeled as a utility or profit maximizer. This has in practice turned economics in a rather technical, morally neutral science. Economics in that approach is almost exclusively about efficiency. But thereby it misses the point that people cannot and do not take their decisions in such an isolation. They are moral beings, and in their decisions, views about what ought and ought not to be done, about what is morally good or bad, play a central role. That gives a different perspective on many issues discussed in economics. Just to give one example, in mainstream economics, the question, what is the optimal level of inflation, is a normal question. In a morally grounded approach, inflation may be seen as bad, not something to be optimized, but to be avoided. My own perspective on the evolution of moral values in society has been strongly influenced by people like Hayek and Popper. There are strong limits to humans' capacity to rationally design an ethical system. Hayek calls the false idea that we can the error of constructivism. Ethical systems evolve over time in a spontaneous process. The prevailing ethical system embodies far more knowledge than anybody can possess. Decentralized decision-making in a market economy is superior to central planning, not only in efficiency terms, but also in moral terms. It allows for freedom, that is the opportunity for people to pursue their own goals with their own knowledge. The mirror side of freedom is that man is responsible and accountable for his choices. That does not mean, to be clear, that we need no government, but that government should only step in where decentralized decision-making cannot work properly and to provide the framework for decentralized decision-making. The market system is imperfect, I should say very imperfect. One of its imperfections is that it is prone to cyclical fluctuations and periodic crises. Although all financial cycles and crises have their own characteristics and are different, they follow a similar pattern and have the same root causes. In that sense, what Mark Twain is often quoted as having said about history also applies to financial cycles and crises. History doesn't repeat itself, but it does rhyme. I see three root causes of financial crisis in market economies: fundamental uncertainty, human creativity, and an evolutionary determined human psychology. Human creativity offers new opportunities as time moves on. But we cannot know now what will happen, how big the opportunities are, and what their contents is. If we would already know now what future opportunities are, they would not be new. Logically, it's a logical point, logically man cannot know in advance the development of his own knowledge. That is part of the human condition, like scarcity. Uncertainty also means that the price of assets cannot be objectively known. That, in combination with human characteristics like greed, desire to act, and herd behavior, can lead to booming asset markets and asset price increases up to a point where they turn out to be unsustainable, and then the whole process goes into reverse, abruptly. Especially at the end of the boom, history tells us there are often cases of immoral behavior. But this is not so throughout the boom phase. Nor, in my view, is immoral behavior at the root of cyclicality. There are also human characteristics that check the development of exuberance, like fear, worries, and panic. But they are not always strong enough and may only get the upper hand when it's too late. This may be the result of evolutionary dynamics. The same characteristics that cause cyclicality are at the root of entrepreneurship, resulting in innovation and productivity growth. They are thereby the sources of economic growth, progress, and increasing welfare, increasing value to society. Cyclicality and crisis are the inevitable byproduct of economic and human progress. This may also explain that so far no ethical system seems to have emerged that acts as a strong brake on cyclicality and crisis. The opposite may rather be the case. Our moral system may well be pro-cyclical around otherwise relatively rigid core values. Taking risk is seen as good in good times, when there is potential for overshooting, while the opposite is the case when the cycle has turned. Then prudence is valued very highly, making it likely that a recovery with healthy risk-taking is postponed. And I do not refer to today, but you may think about it. All this doesn't mean that nothing can and should be done to try to reduce instability without hampering progress and to reduce the costs of instability. But in my view, it does call for both modesty in the ambition of what can be achieved and modesty in changing culture and human motivation as a means to achieve a better outcome. It should also be taken into account that trying to engineer culture and morals too much can easily be counterproductive and lead to disaster. The role of banks in society has evolved over time. Banks have emerged to fulfill four core functions in the economy: providing credit, liquidity, payment services, and facilitating the functioning of financial markets. A market economy cannot thrive without these functions being fulfilled properly. The moral case for a market economy therefore also depends on a properly functioning monetary and banking system. Whatever the more specific business model of banks is, these are therefore the core functions of the banking system. Value is always created to individuals. Society as such is not an acting entity. It has no own ends. Speaking about the needs of society, as sometimes done by critics of the banks, is therefore at least misleading, I should say. It can lead to promoting or protecting the interests of particular groups who happen to have the political majority in a certain period, and it creates rent-seeking behavior with inefficiencies as a result. By providing credit, banks play a decisive role in the allocation of resources in the economy. As Keynes has emphasized, banks hold the key to economic expansion. Schumpeter has argued that they enable the constant restructuring of the economy. Presenting banks as just intermediaries has led to the misconception that banks just pass on saving surpluses in some sectors to sectors that have shortages. This is a confusion between saving and finance. When banks grant credit, they create money out of nothing. That money, when spent, creates income and savings. Banks are and cannot be passive accommodators of what are called the needs of the real economy. The distinction between a real and monetary sector in the economy is also misleading. A modern economy, and modern goes back already many centuries, but a modern economy is an integration of both sectors. The needs, the so-called needs of the real economy, do not exist autonomously. An economy is an organic system where one element has only meaning in relation to all the other elements. It's like, for instance, the lungs and the heart in your body. You cannot look at that separately and ask, what would the body look like without the heart? It would simply not be able to function. And the same is true with the financial sector in an economy. Their credit function means that banks have often to say no to potential borrowers. This makes that throughout history, banks and bankers have never been popular. That is not likely to change in the future. Neither should it, if banks are going to play their role properly. A popular banker you should be careful with. Introducing the concept of client centricity and putting emphasis on it may hamper value creation by banks if understood wrongly. If it's taken to mean that banks should passively honor any demand for credit, and that you have a right to receive credit, it will lead to overcrediting and misallocations. The credit business is risky, by definition. As mentioned earlier, the future is uncertain. This uncertainty cannot be removed, however good risk management is. Things can always turn out worse than hoped or expected. And risk management is not and will never be a hard quantitative science. A bank can only add value by taking risk and facing uncertainty. A bank that doesn't take risk and is afraid of uncertainty doesn't do its job and will turn out not to be viable. In the end, value can only be added and economic progress can only be made by taking the risk that value will be destroyed. Banks are providers of liquidity by supplying demand and saving deposits. This creates great value to economic agents. By holding part of their wealth in liquid form, agents do not have to commit themselves for a long period and remain flexible to respond to unforeseen opportunities or threats. Liquidity is a kind of a special option. And like all options, it has value. It is special in that the owner can decide not only when, but also in what state of the world and for what purpose he will exercise the option. It's a valuable option to have in an uncertain world. And money and liquidity thereby more generally support the freedom that I mentioned earlier. by having this option. Bank deposits are only liquid if people trust the banks. This creates an inherent tension in the bank balance sheet. Credit provision cannot without taking risk, but providing liquidity services means that a bank should be as safe as possible. This makes banks vulnerable to bank runs. The ways, and it's well known, to cope with this tension that have evolved are deposit guarantee systems in combination with minimum capital and recently minimum liquidity requirements for banks and their supervision. The minimum liquidity requirements do not go so far as to ask banks to back up their bond deposits for 100% with liquid assets. Wouldn't that be desirable? One could also raise the issue of whether it would not be better to separate providing credit and liquidity services, and I will come back to those issues somewhat later in my speech. The provision of safe demand deposits automatically leads to a role of banks in the payment, clearing, and settlement chain. That adds value, because without such functions, transactions would not be completed, and the value inherent in the transaction itself would not materialize. Their role in the payment, clearing, and settlement chain makes the banking sector a highly interconnected sector. This has a positive and a negative side. The positive side is that at first shocks can be spread broadly and thereby easily be absorbed. The negative is that this is only true up to a point. For shocks beyond a certain unknown size, the interconnectedness leads to amplification and a potential domino effect throughout the banking sector and throughout the financial sector at large. The resulting financial instability can have a large negative impact on growth and employment, which one would like to avoid. This may make banks too big or too interconnected to fail, and they need not always be very big for that to be true. Finally, banks can facilitate transactions on financial markets by providing investment banking services. This creates value because without those services, some value-creating transactions would probably not take place. At least two issues, have come to the fore here. Should investment banking services be combined with the other core banking functions? Does not investment banking require more risk appetite than the other functions? And if so, isn't there a risk that decisions in the other parts of the bank will be, as it were, contaminated with the risk appetite in the investment bank part? This leads to the issue of separation of retail and investment banking. Back to Glass-Steagall or not. Apart from assessing how important the risk mentioned in this context is, one has to assess also the benefits of, let's say, universal banking. And this advantage mainly comes from diversification and up to a point economies of scale and scope. It has also to be taken into account that separate investment banks still can have a negative impact on retail banks when they fail. Lehman Brothers was an investment bank, after all. And finally, most financial crises had their roots and have their roots and will have their roots in real estate. Providing mortgages is an activity mostly assigned to retail banking. So retail banks by nature are quite risky. On balance, my conclusion is that reintroducing a distinction between investment and retail banking need not be high on the reform agenda. The second issue, I mentioned two issues. The second issue is to what extent should proprietary trading by banks be allowed? Proprietary trading may create a conflict of interest between the client and bank. It may increase the risk of spreading too high a risk appetite and a too aggressive culture in the bank as a whole. It is also more difficult to see proprietary trading as a core value-creating activity of banks. However, it's not so easy to make a sharp distinction between trading for clients and proprietary trading. And may proprietary trading, if well aligned with client trading, not also improve the services to clients by having skin in the game and being actively involved in the price discovery process? This may point more in the direction of ensuring that proprietary trading doesn't become dominant and inconsistent with trading for clients. This is, for instance, the line proposed in the Liikanen report and is also supported by the Dutch committee, Wijfels, for the Dutch banking sector. It's also the view of the Dutch government, who have taken over most of the recommendations of the Wijfels committee. Let me now turn to the financial crisis of 2007-2008. My feeling is that the start of the crisis marks the end of a remarkable era. I call this era, as said before, and as announced, the Great Financial Expansion. And that period has come to a sudden end, in my view, but it's a little bit more difficult to exactly mark the starting point of that period. But it probably has started somewhere in the late 60s. The enormous expansion during this period was driven by developments in finance and monetary theory, deregulation and liberalization, innovations in information and communication technology, and the end of the Bretton Woods system of fixed but adjustable exchange rates. During this period, we have seen a large increase in the size of the financial sector relative to other sectors in the economy and the economy as a whole. A number of very big international banks emerged. Derivative markets developed, enabled by the theoretical work of people like Black-Scholes and Merton. The demise of the Bretton Woods system caused an increase in volatility in financial markets. This provided a further impetus to development of derivatives markets. It was a period in which central banks were made independent and were given the mandate to focus primarily on price stability. This was the result of the unhappy experience in the 1970s and the revival of monetarism under the leadership of Milton Friedman. Central banks came to stand in the center of economic policy. Inflation came down to levels in line with price stability, and volatility of gross domestic product also decreased. All this was combined with continuous, although not spectacular growth in the advanced economies. Price stability was seen as an important contribution to financial stability. In the process of decreasing inflation, interest rates fell to very low levels in historic terms. Since inflation was the main driver of interest rates, rapidly growing credit and asset prices were not seen as a reason to tighten monetary policy. Central banks at least accommodated the great financial expansions, but probably were instrumental in triggering and sustaining this process. The market came more and more to be seen as superior to government in generating welfare and progress. It was the time of Thatcher and Reagan. Deregulation and liberalization also entailed removing barriers to the free movement of goods, services, and capital. This contributed to the globalization of markets and the growth of global trade. Emerging economies started a catching up process with the advanced economies. In China alone, hundreds of millions of people were elevated from poverty. Financial markets were seen as self-correcting to a large extent. The efficient market hypothesis reigned. There was also the widespread belief that shareholders would prevent banks from taking too much risk. Risk management developed quantitative tools and came to be seen as a science. If risks, that was the idea, if risks were professionally managed, they were thought to be under control, and some people thought that you could then leave them alone and that they had to disappear. The emphasis on the power of self-correcting market forces prompted a relatively light touch supervision of the financial sector. The presumption was that if individual banks were healthy, the financial system would be stable. Banks were allowed to use their own quantitative models for assessing risk and capital requirements. There was seen no need to pay separate attention to the financial system as a whole. The internationalization of finance was widely believed to have made the financial system more stable. Shocks to the system could be spread more widely, as I explained earlier. The financial system became more interconnected, but on balance, this was seen as a good thing. The apparent success of the financial sector and its apparent contribution to the economy may also have increased the risk and occurrence of regulatory capture. And it also triggered overconfidence, herd behavior, greed, and other human characteristics mentioned earlier to play their role in the financial boom process that developed. The role of asymmetric and very high bonuses is a very visible aspect of this in the great financial expansion. The theory of finance had a highly micro character. It made great contributions to asset management. The construction of portfolios was presented as finding an efficient combination of risk and return. Consistently outperforming the market was seen as very difficult, if not impossible. More and more the focus came on index investing and using the information of a limited number of rating agencies. With hindsight, the period since the 1970s can be seen as the upward phase of a very long financial cycle. In the course of the great financial expansions, banks became more vulnerable. Their leverage increased without much notice. Supervision was focused on risk-weighted capital requirements and did not pay much attention to leverage also. But even risk-weighted capital buffers became very thin indeed, and there were no harmonized liquidity requirements. And therefore also too little attention for this liquidity aspect of the condition of the financial sector. The size of banks and the financial sector relative to national economies had made the too big to fail problem more acute. Financial institutions may have become more diversified during the great financial expansion, but at the same time the financial system has become less diverse. Financial institutions used similar risk models, information from the same rating agencies, and exposures became more similar, also because of worldwide diversification. In passing, I know the irony that it is likely that this has made the financial markets less rather than more efficient. Anyone familiar with the theory of complex systems would have been very worried by the combination of a highly interconnected system with low buffers and little diversity. For instance, in biology, it's well known that such systems may be very vulnerable indeed. As said earlier, interconnectedness beyond some point is a shock amplifier rather than a shock absorber. The transition from a stable to an unstable regime can be abrupt and be triggered by a relatively small and local shock. That's known from the theory of complex systems. And this may be the role that the US subprime residential mortgage market has played in 2007. The great financial expansion has come to an end with the greatest financial crisis since the 1930s, followed by a deep recession and at best a shallow recovery. And this has been costly. Part of the value that seemed to have been created has turned out to be unsustainable. I reiterate that it is impossible to prevent all systemic risk and all crises if we want to have growth of welfare, if we add value to all our to us all. There is a serious risk, therefore, that the case for being risk averse will now be overemphasized. It's also important to note that the impact of measures in a complex system like the banking sector and the financial system at large can only be imperfectly predicted. There's always a possibility of unintended consequences. The more so if many changes are made at the same time or closely together. Rational policy making can only be piecemeal, as argued by Popper in his concept of social engineering. This implies that it is important to set priorities in taking measures to make the banking system more stable, and that change is a process in which surprises will happen. Policymakers should be on guard for surprises and be prepared to learn from experience. And they should look at the financial system as a whole, and not at banks or other financial institutions in isolation. In my view, the most important measures for creating a more resilient banking system are increasing capital and liquidity buffers and ensuring that these buffers can be used to absorb shocks. So not just minimum levels, but you should have a system in which they can be used. And making it credible that any bank is resolvable not only involving shareholders, but also creditors, while minimizing any contribution by the taxpayer. I say minimizing because I don't believe we can ever have a system where you can totally avoid it. This requires agreement on resolution regimes and the drafting of so-called living wills by systemically relevant banks. A workable living will may necessitate changes in the organizational and legal structure of a number of banks. The objective of writing living wills is to enable banks in resolution to continue to perform their core functions in order to avoid the usually high cost associated with a standstill or bankruptcy. Then monetary policies around the world should be normalized. Very loose monetary policy and so-called unconventional monetary policies may easily cause renewed financial instability and/or inflation in the longer or long term. And they reduce pressure on banks to restructure, within the worst case creating zombie banks or keeping already existing zombie banks in business. I find it difficult how at the moment the European Central Bank at the same time is considering, as I read in the papers, to do another LTRO just before we have to create a banking union. That it should go hand in hand with stepping back from unconventional policies rather than stepping up those policies. Where there is still doubt about the soundness of the banking system, like in Europe, a credible and swift restructuring operation is highly urgent. Without a healthy financial system, no sound, persistent and sustainable economic recovery. It's high time to resolve legacy issues if and where that has not been done sufficiently yet. This requires a transparent and realistic valuation of banks' balance sheet, credible stress tests, mandatory recapitalization, restructuring and resolution procedures. It finally requires governance depth to be made sustainable at the same time. I see Basel III as a step in the right direction. However, even after full implementation, capital buffers remain too low for feeling comfortable. They should be increased further. Moreover, the Basel Committee has recently started a consultation to discuss the balance between simplicity, comparability and risk sensitivity of the capital requirements. My feeling is that Basel III is too complicated and too ambitious in determining risk weights. And this points towards a more prominent role for the leverage ratio in setting capital requirements. What about monitoring and promoting the right culture and ethics in a bank? I would not spend a great part of the supervisory resources on this topic. As argued earlier, norms and ethics are deeply rooted in human nature and cannot be changed at will. And focusing on risk aversion can easily be overdone in the aftermath of this crisis. Some of the norms that supervisors like banks to follow can even be counterproductive. I earlier mentioned promoting client centricity in the context of a bank's credit business. It seems to be difficult to really monitor and assess the internal culture of a firm. It's clear that in the run-up to the crisis, bonus systems were too asymmetric. Measures have been taken, and I would now pause and see how the taken measures play out. Additional taxes on the banking system are not good policy. For a large part, they will be passed on to the clients, and to the extent they are not, they hamper the necessary further deleveraging of the banking system. And supervisors should not be too shy in setting the pace for further reducing leverage. Helwig and Admati are right in stressing that the cost of reducing leverage, if any, are mainly private. Paul Tucker, the outgoing Deputy Governor of the Bank of England, somewhat nuances the analysis of Helwig and Admati, but agrees with their core conclusion. Should regulators directly interfere with banks' business models? I don't think that this is a good idea. The priority measures that I have mentioned have an important impact on the framework in which banks have to operate. They change the rules of the game. Finding business models in that new era after the great financial expansion to provide the old core functions is a task best left to banks themselves in the market process. However, this implies that one direct intervention is warranted. Where banks have been nationalized after the financial crisis, they should be privatized again. And banks that have received capital injections should repay this support as soon as prudently possible. Regulators and supervisors do wise not to interfere with issues like whether it's better to separate investment and retail banking, whether it's right for universal banks to do proprietary trading at all, separate the credit and liquidity function of banks, and 100% reserve banking. Finally, it has been argued that banks may have become too complex to manage, and this may be true. But I would leave it to the market process to correct that. It may well be that improvements can be made in dealing with complexity. The market process is a better procedure for discovering if that is true than making prescriptions for the size of banks. Let me conclude and then at the same time summarize. The best way forward seems to be pursuing the key priorities that I have mentioned, and I will just list them by way of conclusion. Making the banking sector healthy rapidly, where it is not yet the case, in parallel with putting government debt on a sustainable path. Increase capital and liquidity buffers further over time after the Basel III objectives have been reached. Ensure that these buffers can be used when need be. Put greater emphasis on the leverage ratio as a measure of banks' required capital. Create credible resolution regimes in combination with workable living wills. And at the same time allow for different bank business models to be tried and flourish. Normalize monetary policy. This set of policies seems to give the best chances of making the banking sector instrumental in the recovery from the worst crisis in 80 years and to be of best value to all of us. Thank you for your attention.